10.74%. That is VTI 20 years annualized. Dividends reinvested 5.1%. That is international. Same 20 years, same dividends reinvested, same starting dollar. $10,000 into VTI in 2006, 20 years later, roughly $76,800. $10,000 into international in 2006, 20 years later, roughly $27,100. The gap is $49,700. Same decade, same starting line, same dollar. One fund pointed at roughly 3,500 American companies. The other pointed at nearly 8,800 companies across 46 countries. The one with more countries lost. That is the case for VTI. It is clean, it is loud. It is also incomplete. Here is the other side. Rewind, not to 2006 to 1990. Run the same race from 1990 to 2009. The S&P 500 returned approximately 8% annualized. The MSCI AIF, the Standard International Developed Market Index, returned approximately 7.1%. The gap was 0.9 percentage points, not $49,000, 0.9%. And inside that window, from 2002 to 2007, international did not just keep up, it pulled ahead. The MSCI AIF outperformed the S&P 500 in 5 of those 6 years. Same funds, same structure, different window, different winner. The question is not which fund won. The question is which window you are standing in. A 40-year-old engineer in Denver, German-born, moved to the States at 26. Works in automotive systems, makes $112,000 a year, has a 401k 100% VTI 0 international. A coworker told them to add VXUS last quarter. They looked at the 20-year chart and said no. Reasonable decision based on real data. The data was not wrong, the frame was. That is the argument this video is built on. Not that VTI is bad. Not that VXUS is good, that choosing only one of them based on a single 20-year sample is a bet on the window staying open. The numbers will do the rest. VTI holds approximately 3,500 stocks. Expense ratio 0.03%. VXUS holds approximately 8,800 stocks across 46 countries. Expense ratio 0.05%. The cost difference is $2 per year on $10,000 invested. Cost is not the variable here. The variable is return, and return is where the debate gets loud. VTI in 2023 plus 26.1%. VTI in 2024 plus 23.81%. VTI in 2025 plus 17.1%. 3 consecutive years of double-digit gains. No international fund matched that streak. But 2025 had a second number. VXUS in 2025 plus 32.4%. VTI returned 17, VXUS returned 32. International nearly doubled the domestic return in a single calendar year. The MSCI World ex-USA Index climbed 32.6% in 2025. The largest margin of outperformance over the S&P 500 since the mid-2000s. And in 2026 so far, through mid-April, VXUS is up 11.13%, VTI is up 4.88%. The scale tipped, not permanently, not predictably, but it tipped. Everything here is public data, public math. And this is not personal advice for anyone's specific situation, but the numbers describe a pattern that does not care about preference. Now here is the part that moves the scale from backward-looking to forward-looking. JP Morgan publishes an annual set of long-term capital market assumptions. The 2025 edition, covering a 10 to 15-year forecast horizon, projected U.S. large-cap equities to return 6.7% annually. Global equities projected at 7.1%. Non-U.S. markets described as offering more attractive cyclical starting points. 6.7 for the U.S., 7.1 for the world. The gap reversed, not in hindsight, in projection. Robert Shiller, the economist who built the CAPE ratio, forecasted average annual nominal returns of 1.5% for the S&P 500 over the next decade. His 95% confidence interval ranged from -7.7 to +10.7. For European stocks, his forecast was 8.2% annually. 1.5 versus 8.2, that is not a rounding error. The reason is valuation. The S&P 500 Shiller Cape ratio sat at approximately 39.5 as of early April 2026, according to Guru Focus. The only time it was meaningfully higher was the peak of the dot-com bubble. The long-term median is approximately 16 to 17. 39 versus a median of 17. The US market is priced at more than double its historical norm. The MSCI Europe Cape sits at approximately 22, a scale with 39 on one side and 22 on the other. This is the part the 20-year backtest does not show. Backtests measure what happened, Cape measures what was paid. What was paid determines what comes next, not perfectly, not on a schedule, but over 10 to 15-year windows. Cape has been the single most reliable predictor of forward returns. The engineer in Denver looked at 20 years and saw a winner. The Cape ratio looked at the same market and saw a price tag. That has only been this high once before in 150 years. Both readings are accurate. One is a receipt, the other is a forecast. $49,700. Now put the counter case on the table. VXUS carries a foreign tax withholding drag. Dividends from international companies are taxed at the source country level before they reach the investor. The estimated drag is approximately 0.3 to 0.5% annually on total returns depending on dividend yield and country mix. In a taxable account, U.S. investors can claim a foreign tax credit to offset part of this. In a tax-advantaged account, that credit is lost. The tax drag is real, it is not zero. Currency risk is real. VXUS is unhedged. When the US dollar strengthens, international returns shrink in dollar terms. When the dollar weakens, international returns expand. In 2025, the dollar weakened approximately 8 to 9%. According to the Federal Reserve Broad Trade Weighted Index and Bloomberg Dollar Spot Index, which amplified VXUS returns for US-based investors. That tailwind is not structural, it reverses. Europe and Japan have lower corporate tax environments in some cases, but less access to venture capital and significantly less exposure to artificial intelligence. JP Morgan's own LTCMA noted a 20 basis point annual growth boost to developed markets from AI, primarily benefiting US large-cap companies. The case for VTI is not irrational, it is not ignorant. It is a bet on US structural advantages continuing to justify a Cape of 39. The case for VXUS is not hopeful, it is a bet on math. That when you pay 39 times earnings for one market and 22 times for another, the cheaper one tends to catch up over the next decade. Neither bet is guaranteed. Both bets have data. Your father's generation faced this in reverse. In the 1990s and 2000s, the conventional wisdom was to hold 30 to 40% international because emerging markets were the growth story. Then US tech dominance from 2010 to 2024 made international allocation look like dead weight. The Vanguard target date funds still hold approximately 40% of their equity allocation in international stocks. That is not nostalgia. That is a modeling decision based on forward-looking correlation data and mean reversion assumptions. Nobody talks about the 2002 to 2007 window at dinner. Everybody talks about the 2010 to 2024 window. The debate between VTI and VXUS is not a debate about which fund is better. It is a debate about which 20-year window you believe is more predictive of the next 20. If the US Cape compresses from 39 to 25 over the next decade, which is what mean reversion implies, every dollar in VTI absorbs that compression. If international valuations expand from 22 to 28, every dollar in VXUS benefits from that expansion. The math on compression start with 100,000 in VTI. Assume earnings grow at 6% annually, but the multiple contracts from 39 to 25 over 15 years. The contraction alone subtracts approximately 2.9% per year from returns. 6 minus 2.9, 3.1% real return. The same 100,000 in a market with a CAPE of 22. Same 6% earnings growth. Multiple expands to 26. The expansion adds approximately 1.1% per year. 6 plus 1.1, 7.1%. The servicer that manages the index fund gets paid either way. The platform that holds the account gets paid either way. The only variable that changes is the number you see when you log in at 62. 3.1 versus 7.1 over 15 years. On $100,000. 100,000 at 3.1% for 15 years. Approximately 158,000. 100,000 at 7.1% for 15 years. Approximately 280,000. The difference is $122,000. On one decision made once. That is not a guarantee, that is a scenario. Built on publicly available valuation data and a mean reversion assumption. That has held in every previous cycle. The engineer in Denver has 100% of their equity in one country. The CAPE ratio of that country is 39. The long-term median is 17. The last time it was this high. The subsequent decade produced an annualized real return below 2%. They are not making a mistake. They made a decision based on the best-performing window in modern market history. The question is whether the next window looks like the last one. Vanguard says 20 to 40% international is reasonable. JP Morgan projects higher returns for non-US equities over the next decade. Shiller projects dramatically higher returns for European equities. The CAPE spread between the US and the rest of the world is wider than it has been at any point in the last 25 years. None of that tells you what to do. All of it tells you what the scale looks like right now. Mid-year is when most rebalancing happens, not because the calendar says so, because that is when people look. 100% VTI is a position. 0% VXUS is a position, both are active choices. The absence of diversification is itself a bet. The question the 20-year backtest answers is what happened. The question it does not answer is what was priced in at the starting line. 39 and 22. Those are the two numbers on the scale today. The weight has shifted before, it will shift again. The only unknown is whether you rebalanced before it did or after.